Hey, future finance stars. Welcome back to another power-packed session from FinQuiz. In today's lecture, we're going to explore one of the most practical and exam-relevant skills in equity analysis, forecasting. I'm talking about company analysis forecasting. Yeah, you heard me. This is the part where the rubber meets the road. It's not just about crunching numbers. It's about peeking into the future. And if you're sitting for the CFA Level 1 exam, this stuff isn't just useful, it's testable. So, forecasting. You've probably heard that word tossed around a lot, right? But in our world, it doesn't mean just guessing where the economy's headed or throwing darts at a spreadsheet. That's right, we're going from crunching historical numbers to predicting what comes next. And if that sounds like magic, don't worry. We're going to make it make sense, one section at a time. Here's the thing. Analysts live and breathe forecasts. Forecasting in finance is about building a reasonable, defendable expectation of what a company's financials will look like in the future. Why? Because almost every valuation model you'll ever use, from discounted cash flow to residual income, relies on some type of forecast. And if your forecasts are way off, well, your entire valuation is basically junk. Analysts rely heavily on financial forecasts to build investment cases, price targets, and risk analysis. In fact, your entire job as an equity analyst often hinges on how well you can connect what a company has done to what it might do. Forecasting is part art, part science. You're working with data, sure, but you're also working with judgment, expectations, and often a bit of gut instinct, especially when the world throws curveballs, economic shocks, tech disruption, or management shakeups. The good news is there are structured ways to think about it, and that's exactly what we're learning here. Now, before we move on, don't forget, what you're seeing on screen right now are our FinQuiz Battle Ready summaries. These are packed with the visuals and core takeaways you'll need to memorize and recall fast on exam day. If you don't have them yet, check out the link in the description below. They're part of a full FinQuiz ecosystem that also includes Stanley Notes, formula sheets, full-length mock exams, and the question bank. Everything you need to go from confused to confident. All right, up next, we tackle the real meat of forecasting, how to pick your forecast objects, what approaches analysts use, and what makes a forecast decision worthy. Let me put it this way. Forecasting isn't one size fits all. The way you approach it depends on what exactly you're trying to forecast and how much detail or speed you need. So let's break this down like we would in a real research meeting. We'll start with the big picture. What exactly are we forecasting? Imagine you're analyzing a retail company, let's call it Urban Threads. You're trying to estimate next year's revenue. Now, how do you go about it? Well, there are a few ways. Here are the 4 big categories CFA Institute wants you to know. Let's say you're looking at net sales. You could just take the historical trend and push it forward, but that's a bit lazy, right? A better way? Break it into parts. Maybe it's number of stores multiplied by average sales per store. One approach is to forecast the drivers, the components that make up the revenue. So for Urban Threads, you'd ask, how many stores do they have? What's the average sales per store? This approach is great because it gives you explanatory power. If your final forecast is off, you can actually trace back which part, store count or sales per store, caused the issue. It's kind of like figuring out why your favorite pizza place's revenue dropped. Was it because fewer people showed up, traffic down, or because each person spent less, average ticket down? That's driver-based forecasting. Think of Starbucks. Instead of forecasting total revenue, you break it down. Number of locations plus average ticket size plus footfall per day. Much better insight, right? Now, sometimes analysts skip the drivers and just forecast the line item itself, like net sales or SG&A expenses. This is more of a direct approach, especially if the line item is stable or doesn't have a clear driver. For example, maybe depreciation is expected to be flat year over year. Why complicate it, right? So, this one's for when you just go straight to the source. You forecast the financial statement line, like net income, without modeling the smaller drivers. When's that useful? Well, if you're dealing with stuff that doesn't really change much or isn't a big deal, like amortization or small items tucked in the balance sheet, or maybe the line just doesn't have clear drivers. You don't want to overthink it, but sometimes we don't even go that deep. Instead, we forecast summary measures. Now we're talking big picture metrics like free cash flow, earnings per share, or total assets. This can be super efficient and handy, especially when time is tight, like during earnings season. But just be careful. You're losing detail and sometimes transparency. Plus, it's a lot harder to backtest or audit those forecasts. If someone asks you, why did you forecast $3.10 EPS for next year? You might find yourself mumbling something vague unless you've built it up from the components. And then there's the wild card, ad hoc objects. Now, this one's spicy. You're forecasting things that haven't even shown up in past statements, like a massive legal settlement or unexpected fines or maybe a natural disaster that'll mess up next quarter's results. It's tricky. You're working with uncertainty and a lot of assumptions, but sometimes these are the most important calls an analyst can make. Imagine you're analyzing a big pharmaceutical company and they just got sued over a drug side effect. That potential payout isn't on any income statement yet, but it could blow up earnings next quarter. That's where forecasting gets more speculative, but also more valuable. Think Boeing after the 737 MAX grounding. Revenue was predictable until it wasn't. Analysts had to forecast losses from lawsuits and grounding costs even before they hit the financials. So depending on the nature of the item, the data available, and the level of materiality, your method is going to shift. That's what makes forecasting both an art and a science. All right, next big idea. Look, as analysts, we're not here to play Sherlock Holmes every time. It helps a lot when companies just tell us what's going on. So the smart move, focus on stuff that's regularly disclosed because you can verify it. You don't need to build fantasy models off assumptions nobody can double check. So it's all about getting practical, guys. When you're deciding what to include in your model, start with what's regularly disclosed. Seriously, you want data that's dependable, available every quarter or at least annually, and ideally something investors already care about. Like if a retail chain reports net sales, store count, and sales per store every quarter, use that. It's clean, reliable, and you can tie it back to third-party data like census retail numbers or credit card spending indexes. Let's go back to our Urban Threads example. If they publish net sales and number of stores every quarter, and you can verify those figures with, say, retail industry databases or government statistics, that's a solid foundation for your forecast. And trust me, don't go building some 17-tab Excel monster based on hard-to-find data. It might feel fancy, but it's a pain to update, and it usually doesn't forecast any better. Complexity doesn't equal accuracy. In fact, simpler models often outperform in real-life investing because they're easier to update, audit, and explain. Plus, if one or two variables change, you won't need to rebuild the whole thing from scratch. All right, now that we know what to forecast and we're keeping our models clean and practical, it's time to talk strategy, how we forecast. There are 4 big approaches analysts typically use. Each has its own flavor depending on the type of company you're analyzing and the kind of data you have access to. Let's start with the most straightforward one, historical results. Super straightforward. Just take past data and assume the trend continues. Picture this. You're analyzing a utility company. Let's say it's Northern Power Grid. Their earnings, cash flow, and margins barely change year to year. That's because they operate in a regulated, low volatility industry. For a business like that, it makes total sense to say, hey, the past 5 years have been stable, so next year probably will be too. That's what we mean by using historical results. It works great for stable industries, non-cyclical businesses, and companies with predictable patterns, especially if you're forecasting stuff like maintenance, CapEx, depreciation, or minor line items. But here's the catch. This method does not work well for companies that are going through big changes. A boring old utility company? Sure, historical is fine. Tesla? Not so much. Say a company just announced a merger or they're pivoting to a new business model. In that case, history is no longer a reliable guide. Using the past in a situation like that is like using last year's weather report to plan your beach day today. It could totally mislead you. Which brings us to our second method, historical base rates and convergence, or what we call HBRC. This one's a bit more technical, but super cool. You're basically saying this company is likely to move toward the industry average over time. This is more of a benchmarking approach. Instead of relying only on the company's own history, you look at what typically happens in the industry and assume your company will gradually move toward that average over time. But there's some art to this science. You gotta pick the right metric, the right peer group, the right time frame. This approach is perfect for mature sectors with lots of comparable data. For example, suppose you're analyzing a small e-commerce firm that's scaling rapidly. You might say, eventually they'll settle into the same operating margin range as Amazon or Alibaba once they mature. That's convergence thinking. This works really well when you're forecasting companies in well-established industries with plenty of comparable firms. So if you're looking at banks, airlines, or grocery retailers, you've got lots of data to work with. You can average margins, return on equity, or asset turnover across a peer group and project a similar path. But HBRC isn't a magic wand either. It breaks down fast when you're looking at startups, tech disruptors, or businesses operating in a new niche. Like you can't really benchmark Tesla in 2011 against Ford or GM. It was just too different. A mid-sized grocery chain might eventually converge to the same profit margin as Walmart or Kroger. And here's the thing, this method requires analyst discretion. You have to pick the right peer group. You have to decide which metrics make sense to converge. And you have to define your time frame. Are we talking 2 years, 5 years, 10? That's where your judgment and experience come in. And yes, that's testable on the CFA exam. They'll want to know when it's appropriate and when it isn't. Let's move on to management guidance. Now, let's be honest, this one's a bit of a gamble. This one's based on what the company itself tells you. Public companies often publish guidance in their earnings calls or press releases. You'll see statements like, we expect revenue growth between 6 and 8% this fiscal year, or CapEx will be around $1.2 billion. So it offers forward-looking data. When public companies tell investors, hey, we expect revenue to grow 10% next year, that's guidance. It's useful, sure, but be careful. You should always check their assumptions. See how accurate they were in the past and focus on what they can actually control. Remember, CEOs are great at storytelling, not necessarily forecasting macro trends. As an analyst, you can absolutely use this as part of your forecast. But, and this is a big but, you have to be skeptical. You can't just blindly copy-paste it into your model. Let me give you an example. A company says they'll reduce SG&A by 10% next year. Sounds great, right? But are they really going to lay off staff, cut back on marketing? If their past guidance has been overly optimistic, you better be careful. Management guidance is most useful for line items that management can actually control, like planned capital expenditures or payroll. But if they're giving guidance on macro-sensitive things like revenue growth in a recession, take it with a grain of salt. They don't have a crystal ball either. And finally, the most flexible but trickiest of all approaches, analyst discretionary forecasts. Sometimes you just can't rely on the past or on management or on peers. So it's up to you, the analyst, to apply judgment. How do you forecast revenue for SpaceX before it went public? You're on your own, buddy. This is where you, as an analyst, have to roll up your sleeves and use your own judgment. Maybe you're using surveys, maybe you're building a probability weighted model, maybe you're relying on a combination of sentiment, channel checks, or sector specific leading indicators. Let's say you're analyzing a company in the luxury travel industry. Post-COVID, it's hard to rely on historical data or guidance because the business is recovering in a way that's never happened before. In that case, you might say, I think international travel will rebound by 30% next year, and this company's revenue will recover in tandem. This approach is super common in cyclical sectors or when the company has no close comparables. Think of unique business models or early stage innovators. Or it could just be that the company doesn't issue any guidance at all. In that case, it's up to you. Here's a question that trips up a lot of new analysts. How long should your forecast cover? There's no one-size-fits-all answer. It really depends on the company, the industry, and your purpose. Let's say you're working at a hedge fund with a short-term trading strategy. You're mostly interested in the next 2 quarters. Maybe a company is about to launch a new product or close a major deal. In that case, your forecast might only go out 6 months. Now let's flip the situation. You're at a pension fund looking at long-term investments in infrastructure companies. Those businesses don't change overnight. You might build a model that forecasts 5, even 10 years out. Industry cyclicality plays a big role too. Take mining or heavy machinery, those businesses go through long cycles. You can't just look at next quarter's earnings and call it a day. You'll need a multi-year view to understand the ups and downs. And then there's company-specific stuff. If a firm just did a massive restructuring or is in the middle of a turnaround, you might need a longer horizon to really see the full effect. Sometimes your employer will set the forecast horizon for you. Some equity research firms mandate a 3-year model. Others might ask for just 1 year with a terminal value assumption tacked on. And of course, your personal style as an analyst matters too. Some folks love short-term models that they update every quarter. Others prefer to zoom out and think big picture. What matters is this: your forecast horizon should be long enough to capture the meaningful changes in the business, but short enough that your assumptions don't become pure speculation. You're not trying to predict the future with perfect accuracy. You're trying to make a reasoned estimate based on what's knowable today. Bottom line, forecasting isn't about picking one method and running with it blindly. It's about knowing your company, your industry, your tools, and sometimes trusting your own brain more than the spreadsheet. All right, team, let's move into the heart of financial forecasting, revenue. If you've ever built a financial model, you know this is where it all starts. Revenue is the top line, and everything else, costs, profits, margins, flows from it. So nailing your revenue forecast isn't just helpful, it's essential. Now the question is, how do we go about forecasting revenue? There's no one magic formula here. Instead, think of it like planning a road trip. You can either start with the destination in mind and work backward. This is top down, folks. Or start from where you are and build step by step. I'm talking bottom up here. Let's unpack both. Top down starts at the macro level, think big picture, and works its way down to the specific company you're analyzing. The first method under this approach is growth relative to GDP. This works well if you're looking at a company whose growth is tied closely to the economy. For example, let's say you're analyzing a company like Caterpillar, which makes construction and mining equipment. If the economy grows at 3%, and historically Caterpillar's revenues have grown at around 1.5 times GDP, you might assume 4.5% revenue growth going forward, adjusted for where they are in their business cycle. Of course, this assumes a steady relationship between GDP and revenue. That's not always the case, so tread carefully. Another top-down tool is market growth and market share. This is classic for industries like consumer goods or tech. Imagine you're analyzing a smartphone maker that operates in a $500 billion global market. If that market is growing at 6% per year and you think your company will increase its market share from 5% to 6%, then boom, your forecast becomes a mix of market growth and competitive positioning. Think of it like this. You're not just asking how fast is the pie growing. You're also asking how much of the pie will my company grab? This method is especially powerful when there's strong industry research available. But keep in mind, it's all about reasonable assumptions. Too aggressive, and your forecast will look like wishful thinking. Too conservative, and you might miss the company's real potential. Now let's flip the lens. Instead of starting with the economy or the whole industry, bottom-up forecasting builds from the ground up, using company-specific data like units sold, prices, or store count. First up, volumes and average selling prices. This is great when you've got detailed product-level data. Think airlines or media companies. If Delta Airlines flies 200 million passengers per year and charges an average fare of $300, that's $60 billion in revenue. If they plan to increase volume by 5% and raise fares by 2%, you can do the math. It's super granular and gives you tons of flexibility, but it also needs a lot of reliable input, so it works best for companies with consistent, trackable sales data. Next is revenues by segment or product line. Let's say you're analyzing Apple. You wouldn't forecast total revenue as one number, you'd break it down: iPhones, iPads, Macs, services, and so on. Why? Because the drivers and growth rates are different for each. iPhone sales might be flat in North America, but booming in India. Services might have recurring revenue and higher margins. Segmenting lets you capture these nuances and spot trends others might miss. Then there's capacity-based forecasting, which is often used in retail. Think of a coffee chain like Dunkin'. You'd want to forecast revenue based on the number of stores and average revenue per store. If they open 200 new stores and same-store sales are up 3%, that's a clear path to forecast growth. Return or yield-based models are another option, typically used in banking or insurance. Here, revenues come from interest earned on loans or policies. So you'd look at balances and interest yields. For example, if a bank has $100 billion in loans at a 5% average yield, you're projecting $5 billion in revenue from that book. And of course, analysts often combine top-down and bottom-up. That's right. Just like you wouldn't rely on one GPS app for a road trip, you don't have to stick to one approach. A combo approach gives you checks and balances. Maybe you use GDP growth for the industry trend and bottom-up detail to validate your forecast at the company level. Smart and practical. Now let's address something candidates often overlook. Not all revenue is created equal. That's why it's important to separate recurring from non-recurring revenues. Identifiable non-recurring items are the easy ones. They're explicitly disclosed. Maybe the company sold a piece of real estate and booked a one-time gain. That's not part of ongoing operations, so you shouldn't include it in your base revenue forecast. Management usually flags these in earnings calls or filings. But the tricky part is non-identifiable, non-recurring items. These are temporary surges or drops that you, as the analyst, have to recognize and adjust for. Maybe a retailer saw a big spike in Q4 sales because of a viral TikTok trend. That's great, but is it repeatable? If not, don't build your whole forecast around it. This is where judgment matters. You've got to distinguish between what's sustainable and what's a fluke. Okay, approaches for forecasting revenues. Now, two last concepts to round this out. First is risk consideration. When you're forecasting revenue, you've got to think about what could go wrong. What are the competitive risks? Is there a new entrant disrupting the industry? What's happening with inflation or raw material prices? Are consumers cutting back on discretionary spending? Let's say you're analyzing Netflix. One risk is increased competition from Disney Plus, Amazon, and Apple. That could pressure both subscriber growth and pricing power. If you're not accounting for these risks, your revenue estimate might be too rosy. And second is scenario creation. This is where you build multiple versions of your forecast. Maybe a base case, a bullish case, and a downside case. Each scenario includes different assumptions about volume growth, pricing, macroeconomic trends, and competitive pressure. For instance, if you're modeling Tesla, your base case might assume steady EV adoption in the US. Your upside case assumes strong growth in China, and your downside case accounts for delays in new model releases. Scenarios help you stress test your valuation and show your client or boss that you've thought through different outcomes. And remember, every concept we're discussing is captured in the FinQuiz battle-ready summaries you're seeing on screen. They're not just for memorizing, they're for truly understanding how real analysts build revenue forecasts and how to apply that on the CFA exam and beyond. You'll find the link to grab these summaries and our question bank, formula sheets, and mock exams in the description below. We've now built up the core of the financial forecast. But next, we'll move from the top line down and start thinking about forecasting expenses and margins, because after all, revenue's just the start. What matters next is how much of it a company gets to keep. All right, team, now it's time to work our way down the income statement, because let's be honest, revenue looks great on the surface, but what the company keeps after expenses is what really matters. And this is where it gets a little trickier. Welcome to forecasting operating expenses and working capital, a space where disclosures are fewer, assumptions are fuzzier, and your judgment as an analyst really starts to shine. Let's start with a broad view. General approach. Operating expenses don't always get the same disclosure love that revenues do. Companies will often give you detailed revenue breakdowns by geography, product line, whatever. But when it comes to expenses, things are usually a lot more aggregated, so your forecasts for costs often have to be broader. Instead of saying marketing costs will go up 7.2%, you're usually estimating whole categories, SG&A, cost of sales, and so on. And you want those expense forecasts to be aligned with your revenue assumptions. That means if you're forecasting an aggressive sales ramp, your expense growth better not stay flat, unless you've got a strong case for serious cost control or operating leverage. Let's say you're modeling a streaming company, call it Cineflix. You project a 25% jump in revenue from new subscribers. It wouldn't make sense to keep marketing and content acquisition flat. You've got to adjust your expenses accordingly or your model won't hold up. Okay. Now, when it comes to cost of sales, this is usually one of the biggest line items on the income statement, and it's tightly tied to your sales forecast. So naturally, it's often projected as a percentage of sales. Say you're modeling Nike. Historically, their cost of goods sold might be around 56% of revenue. If you believe their supply chain is improving and input costs are falling, maybe you forecast that dropping slightly, say to 55%. A small shift like that can have a huge impact on gross profit. And this is where market share comes into play. If Nike's gaining share, they may have more pricing power or better economies of scale, which could help margins. But if they're losing share to Adidas or a new competitor, margins might compress. Every percentage point matters. Small variations in gross margin can have a big ripple effect on cash flow. Why? Because gross profit is what funds everything else. R&D, marketing, expansion, and shareholder returns. Want to go even deeper? You can analyze costs by segment or product line. For instance, a retailer might have one segment focused on premium goods and another on discount items. The margins are totally different. If the sales mix shifts more toward premium, your cost forecast should reflect that. There's also hedging. Companies with exposure to volatile raw materials like airlines with jet fuel or consumer goods companies with packaging might use derivatives to lock in input prices. If hedging is in place, rising commodity prices might not hit cost of sales as hard. And while comparing margins across competitors is helpful, don't assume they're always comparable. Different cost structures, accounting policies, or regional factors can throw off your comps. SG&A expenses. Now, SG&A, selling, general, and administrative expenses, is where things get messy. These costs are less directly linked to sales, which makes them harder to forecast. Some parts, like distribution costs, may scale with revenue. Others, like executive salaries or legal fees, are just there, regardless of how many widgets the company sells. A good rule of thumb is to forecast some SG&A elements as a percentage of revenue, especially selling and distribution expenses. Let's say a company spends 10% of revenue on marketing historically. Unless there's been a major strategy shift, that ratio might hold going forward. On the flip side, general corporate costs, stuff like admin salaries, rent, HR, are often fixed or semi-fixed. For these, you might just apply an inflation-based growth rate, like 2% to 3% annually. Here's a common real-world dilemma. You'll often see companies disclose SG&A at the segment level, but they don't break it down into individual cost buckets. So you know SG&A was $1.5 billion for a segment, but you don't know how much went to logistics versus HR versus Salesforce bonuses. That's where you, as the analyst, have to make reasonable assumptions and clearly document them in your model. Let's say you're modeling Amazon. Their logistics costs are high and tied closely to e-commerce volume. But their AWS cloud segment probably has a different SG&A profile, lower distribution costs, higher tech staff. You can't apply a single ratio across the whole company without adjusting for these nuances. Last but definitely not least, working capital. This one's sneaky because it lives on the balance sheet, but it absolutely affects your cash flow forecast and by extension your valuation. Working capital includes current assets and current liabilities, accounts receivable, inventory, accounts payable, and so on. And the trick is, these items move with operating activity. To forecast working capital, you typically use efficiency ratios, things like days sales outstanding, DSO, inventory turnover, and days payable outstanding, DPO. For example, if a company collects receivables in 30 days on average and you forecast $1 billion in sales, then you can estimate how much will be tied up in receivables at any given point. If your company is scaling up quickly, working capital usually expands, meaning more cash gets tied up in things like inventory or delayed customer payments. That's a cash flow drag. On the flip side, if a company stretches out its payables, say taking 60 days instead of 30 to pay suppliers, that frees up cash, improving short-term liquidity. But it might strain supplier relationships. And remember, working capital assumptions should be consistent with your cost and sales forecasts. If you're forecasting big inventory buildup for a product launch, your inventory line should grow in sync. Okay, folks, we're almost at the finish line. So far in this forecasting journey, we've tackled revenue, expenses, working capital, financing costs, etc. Now, in this final stretch, we zoom in on the big ticket items, long-term investments, and how a company plans to pay for them. This means forecasting capital expenditures, depreciation, and of course, capital structure, aka the mix of debt and equity. Let's break this down into two parts: understanding and projecting long-term assets, and forecasting the company's capital structure. Let's start with the big stuff that sits on the asset side of the balance sheet for years: property, plant, and equipment, and intangibles like patents and trademarks. So, long-term assets are the big ticket items a company invests in to keep the engine running or to build a bigger engine altogether. We're talking about property, plant, and equipment, PP&E, like office buildings, delivery trucks, robotics in a factory, or intangible assets such as patents, software licenses, or brand rights. These assets show up on the balance sheet, and they increase primarily when the company spends money on capital expenditures, also known as CapEx. On the flip side, they go down over time due to depreciation and amortization, which reflect the wear and tear or gradual obsolescence. So your job as an analyst is to forecast how these assets change year after year as the company invests, grows, or even shrinks. These long-lived assets don't move much from quarter to quarter, but over time, they tell you a lot about a company's strategic direction. The key driver behind increases in these assets is capital expenditures, or CapEx. And there are two types to keep in mind. First, we've got maintenance CapEx. This is the bare minimum investment needed just to keep the business running. Think replacing worn-out machines, upgrading servers, or repainting stores. It doesn't grow the business, it just keeps things from falling apart. Now, when it comes to forecasting maintenance CapEx, a simple but effective starting point is to look at historical depreciation and amortization, because depreciation reflects the systematic reduction in asset value over time. In a sense, it's the accounting world's way of saying, hey, you've used up part of your equipment this year. So analysts often forecast it by looking at historical depreciation expense. If the company depreciated $50 million last year and inflation on equipment is expected to be 3%, you might forecast $51.5 million in maintenance CapEx. But be careful, if the company has gone through a big strategic shift, maybe they sold off a division or shifted from owning assets to leasing them, then that historical depreciation number might not be the best proxy anymore. That's where your judgment comes in. Always ask, is this company trying to maintain its size, or is it gearing up to grow? Now let's talk about forecasting growth CapEx. This one's a bit more flexible because it depends on what management is planning to do. Are they opening 50 new stores, expanding to a new region, launching a new product line? All of that requires cash, and your forecast should reflect it. Growth CapEx is about forward-looking stuff: new factories, additional retail locations, product development labs, anything that increases the company's capacity to generate revenue. This is what helps businesses scale up. One smart way to tie growth CapEx into your model is by relating it to projected revenue growth. For instance, if the company is expecting revenue to grow by 10% and historically it spends about 5% of revenue on expansion, then you might forecast 5% of next year's revenue as growth CapEx. If the company is expecting a 20% jump in revenue next year and they're aiming to enter new markets, you'll want to reflect that in your CapEx assumptions. And remember, capital expenditures increase the asset base, which in turn affects depreciation and amortization going forward. You don't just forecast CapEx and stop there. You have to follow through, because those new assets will eventually start depreciating too. Bottom line, maintenance CapEx keeps the lights on. Growth CapEx helps the business scale. Now, let's flip to the other side of the coin. Depreciation and amortization. When the company invests in long-term assets, they don't expense it all at once. Instead, they spread the cost over the asset's useful life, say 5, 10, or even 20 years. To forecast depreciation, you need two things: the balance of PP&E and an estimate of the asset's useful life. A rough but practical way to do this is to calculate historical depreciation as a percentage of PP&E. So if a logistics company had $1 billion in PP&E and recognized $100 million in depreciation last year, that's a 10% rate. Unless management says otherwise, you can project that rate forward. The same logic applies to amortization for intangible assets, like capitalized R&D or patents. If a software firm is amortizing 20% of its intangible assets annually, that can serve as your base for forecasting. And don't forget, depreciation and amortization are non-cash expenses, but they're key inputs to your free cash flow model. They reduce earnings, but not cash. If you want to get more precise about depreciation or amortization, dig into the notes of the financial statements. Companies often disclose useful lives, like buildings depreciated over 20 years or software amortized over 5 years. That gives you even better grounding for your forecast. Okay, so we know what the company's spending on long-term assets. Now let's figure out how they're paying for it. This brings us to capital structure forecasting, basically the mix of debt and equity the company uses to fund its operations and investments. The most common forecasting tool here, leverage ratios. Now, let's explore few classic ratios analysts use as forecast anchors. First up, debt to capital tells you what portion of the company's financing comes from debt. Debt to equity compares borrowed funds to what shareholders have invested. And debt to EBITDA, it gauges how easily a company can pay back its debt using its operating cash flow. Let's say the company has consistently maintained a debt to EBITDA ratio of 1.5, and you're projecting EBITDA of $300 million next year. That implies they're likely to carry $450 million in debt unless management has said otherwise. And if the company's planning a big investment push or just announced a leveraged buyout, your assumptions may need to flex to accommodate a rising leverage profile. What if management hasn't said anything? No problem. You look at history. Has the company been reducing debt year over year? Are they targeting an investment grade credit rating? Do their peers carry more leverage? Sometimes you'll notice that similar companies in the industry operate with significantly higher or lower debt levels. That's a clue. If your company's gearing up for growth, they might inch toward the industry average. Also, remember that capital structure doesn't just affect the balance sheet, it affects interest expense, net income, return on equity, and free cash flow. So your assumptions here ripple through the rest of your model. Now, if you're lucky, management will tell you exactly what they're aiming for. You'll find this in investor presentations, earnings calls, or regulatory filings. They might say something like, "We plan to maintain a net leverage ratio below 2.0x, or we're targeting a 50-50 debt to equity capital structure." Boom, that's gold for your forecast. You can plug in those targets directly and build your projections around them with confidence. But even if they don't give you an exact number, you might find hints in other places like debt covenant ratios that gives you a hard ceiling to work with. And sometimes management lays out CapEx plans that imply a certain level of funding is needed. So, if their growth plans are aggressive and cash flows are tight, you might forecast additional borrowing or equity issuance even without direct guidance. So, when you're building your capital structure forecast, don't just go by the math. Think like an analyst. Look at what they've done in the past. Understand where they're headed And if management gives you targets or guardrails, use them. It'll make your forecast stronger, more realistic, and way more defensible in front of clients or managers, or during an investment pitch. Okay, folks, we're almost done, but this last step is a powerful one. So far, we've built out a complete financial forecast. Revenues, costs, capital structure, long-term assets, you name it. But here's the truth. No matter how solid your model is, the future's uncertain. And that's exactly where scenario analysis comes in. Scenario analysis is the final layer in forecasting. It's your way of saying, let's not just stick with one single outcome, let's consider how this model holds up under different possibilities. Because out in the real world, nothing ever unfolds exactly as planned. Interest rates spike. A competitor launches a game-changing product. Supply chains break down. Inflation surprises to the upside. Or suddenly your company becomes the target of new regulation or a takeover. It happens. So instead of being caught off guard, analysts build multiple forecast scenarios, each one shaped by a different combination of risk factors. Now, the purpose here isn't to be a fortune teller. It's about laying out the possibilities. What if things go better than expected? What if they go worse? And what if something unexpected shows up entirely? When building these scenarios, you start by identifying the key forces that could swing performance off course. Economic cycles are a classic one. Maybe you forecasted revenue growth under the assumption of a stable economy, but what happens if there's a mild recession next year? That might mean flat sales, delayed projects, or even layoffs. Market competition is another huge one. Let's say a new player enters the scene with a lower price point. Suddenly, your pricing power is at risk. Or imagine you're analyzing a pharmaceutical company and a rival gets early FDA approval. Your growth outlook needs to change fast. Then there's inflation and deflation. We've seen both sides of this in recent years. Commodity spikes, shipping bottlenecks, price wars. These all impact margins, purchasing power, and cost structure. And of course, there's technological innovation. That's a big one. A breakthrough in automation could slash costs and boost efficiency. But at the same time, a disruptive product might reduce demand for your client's flagship offering. So you've got to ask yourself, if any of these factors tilt, what happens to the forecast? Scenario analysis helps you move beyond the traditional best guess forecast. Instead of one future, you create 3, maybe even 5, that reflect a variety of possible paths. For example, you might build a base case that reflects your most likely assumptions. Then you create an upside scenario. Maybe demand is stronger, costs come in lower, and interest rates drop. Finally, you model a downside scenario. Perhaps sales fall short, margins get squeezed, and the company delays expansion. By doing this, you're not just forecasting numbers, you're building strategic awareness. You're showing that you understand risk, that you've thought through the what ifs, and that you can adjust when the real world refuses to follow your script. Let's make this real with a business example. Imagine you're analyzing a mid-size electronics manufacturer that makes smart home devices. Your base case assumes they'll grow sales by 8% next year, launch 2 new products, and expand into 1 new international market. That's your baseline. But in your upside scenario, maybe a new battery technology drops component costs by 15%, making production cheaper and margins fatter. They sell more units and post record earnings. On the other hand, in your downside scenario, a major tech firm releases a competing product at half the price. Suddenly, your client loses market share, drops prices, and delays its overseas expansion. Now you've got 3 versions of the future, each one built off real-world factors that could actually happen. But the value of scenario analysis goes way beyond the spreadsheet. It helps you compare your outlook with other analysts. Maybe the consensus sees 12% revenue growth, but you're at 8% in your base case with a downside scenario at 3%. When a client asks why you're more conservative, you can walk them through your assumptions. It also guides investment decisions. If your downside scenario still delivers decent returns, that's a resilient business. If your upside scenario is the only path to a good valuation, that's risky. Scenario analysis also plays a huge role in strategic planning. It helps companies prepare for multiple futures. They might keep a leaner cost structure in case growth slows, or they might invest in flexible supply chains to handle swings in demand. As an analyst, you're not just modeling numbers, you're modeling flexibility. You're giving the decision makers a toolkit to act, adjust, and adapt. Take tech shifts, for example. Let's say you're analyzing a company that makes old school thermostats. Suddenly, smart voice-controlled systems take over the market. In your downside scenario, demand tanks. But what if they pivot fast, launch a Bluetooth-enabled version, and ride the trend? Now, your upside story kicks in. That scenario isn't just a spreadsheet tweak, it's a snapshot of whether the company adapts or gets left behind. In short, scenario analysis is your safety net and your superpower. It shows you've thought beyond the forecast. It adds depth to your recommendations, and it protects your model from the illusion of certainty. Because the one thing we know about the future, it's always full of surprises. And that's it. That's your final building block in company analysis, forecasting. You now have the tools to model a company from top line to bottom line, evaluate strategic decisions, and build robust forecasts that reflect both reality and risk. And that's what separates a CFA candidate who just memorizes formulas from one who's thinking like an analyst. And if you want to master this stuff with total confidence, check out the FinQuiz battle-ready summaries you've been seeing on screen. They've helped thousands of candidates break down complex material into actionable, exam-ready knowledge. Grab your copy through the link in the description. And don't forget, we've got Stanley Notes, formula sheets, mock exams, and more to help you stay one step ahead. Take a deep breath. You've earned it. Let's go pass this exam. See you in the next lecture.